Hello, this is Jeremy from Gradient Accounting, and welcome to our 2025 tax law update video. So I know it's hard to believe, but we are already at the end of 2025. It's now November, and so we did want to record this video to make sure you're all up to date with the new tax laws, which were passed this year. We want to let you know what changed, what didn't change, and anything else that would be useful for you to know about this new law. So this presentation is going to focus on the tax law which was passed in July 2025, commonly known as the One Beautiful Bill Act, OBBA, OB3. And just a couple caveats before we start the video. This video is going to focus only on the tax updates from that law. So there were some other things like involving Medicare and other aspects. We're not going to touch on that. We're also not going to touch on any of the politics involved to get to that act. We're just going to focus purely on what's in the bill. Also, we know a lot of you guys are very busy, and so we do have a PDF accompanying document. So if you don't have time to go through this whole video, obviously we will try to make it as brief and to the point as possible. But if you don't have time to go through it right now, we do have that PDF accompanying document that you can have a look at. So let's get into the tax updates. All right, so let's get into it. The content covered here in this video are going to be personal tax updates first. Then we'll look at some of the small business provisions, so business taxes. And after that, there's a few other notable things that we wanted to make you guys aware of. So getting into the personal tax updates, and just two quick things before we get into it. One, the tax law features some items that were new, that basically didn't exist before. And there were some other areas in which things were set to expire at the end of 2025, and they got extended. So we'll try to make a distinction between what those were. And in addition to that, some changes have been made permanent, and others are set to expire at a certain date. So we'll try to make you guys aware of that as well. So getting into the personal tax updates, we're going to start with tax and tax rates. So these are the personal tax rates for 2025. Not a lot changing here compared to previous years. These things do get adjusted for inflation. So you won't really notice a big difference in tax brackets for this year. One thing to note about this that we like to tell people is that if you are in a certain tax bracket, it doesn't necessarily mean that you're paying only that percentage of taxes. So let's say you're in a tax bracket that's paying 35%. You're not actually paying 35% on all your income. The way it works is you're paying the 35% on income over a certain amount, but the income below that you're paying lower percentages on. So it's kind of an urban legend that, once you get into a bigger tax bracket, all of your income will be taxed at that rate. It's not actually true. You're taxed at lower rates until you get to that amount of income. So a little bit complicated, but just wanted to dispel that myth about tax rates. So this was a big one. You probably heard about this on the news. The no tax on tips in overtime, effective 2025. So it's already effective. It's not something that you will notice immediately. This for 2025, this is going to be an adjustment that gets made at the time that a tax return is done. So you won't notice this if you're getting tips. You won't all of a sudden notice that your paycheck is higher. This is something that will be adjusted at tax time. And then going forward, that may change. So how does it work? It is up to $25,000 in eligible tips incomes. There's rules and regulations about what qualifies as eligible tip income. There is a phase out for this. So if you're making over 150K or 300K if you're married, that will phase out the no tax on tips. And overtime, up to $12,500 in qualified overtime. Now, the thing to be careful about here is if you're working overtime, you're usually making time and a half, right? So you get paid $40 an hour For the overtime, you're getting paid 60. The part that's not taxable would not be the $60 an hour you're making for the overtime. It would just be that $20 an hour extra that's added onto the 40. That's the part that's the qualified overtime. That's the extra portion, and that is up to 12,500. That there will not be taxed, basically. Same phase out as above. These two things do expire in 2028, so that's something to be aware of. Now, about tipping, there's a lot of questions about, who can take tips, what is a tip, what isn't a tip. And so the IRS has released some guidance regarding this. So these are some of the sectors that customarily receive tips and in which the no tax on tips can apply. So just a list of these to be aware of. And the other quick tax note is about the estate tax. So that has now been made permanent. Not a big change here, but it was one of those things that was set to expire. Estate tax is now $15 million starting in 2026. Okay, now that we've talked about personal taxes, let's go ahead and move on to personal deductions, the good stuff. So looking at personal deductions, we traditionally, as usual, have the standard deduction or itemized deduction, right? And obviously you want to be taking the one that results in a more beneficial tax result for you. So the standard deductions continue to be higher than they were multiple years ago. And so you'll notice that they just continue to go up and continue to get adjusted for inflation. So if you're taking the standard deduction, nothing's going to change. Your standard deduction will keep going up. So in 2025, standard deduction increases to $15,750. I think that's a slight increase on what was supposed to be this year for individuals, and $31,500 for joint filers. There is also an enhanced standard deduction of $6,000 for seniors, so 65 and older, if you have an AGI of less than 75K. So there's that new deduction, which is that's one of those new tax provisions, and that does also expire after 2028. Now, these are some new things. So, and again, this is going to start in 2026, so next year. So traditionally, if you took the standard deduction, you weren't actually allowed to deduct charitable contributions. However, there is a new provision that says, well, it still works like that. However, you can take a small deduction of up to $1,000 or $2,000 if married for charitable contributions. So this is something to be aware of in 2026, that even if you are someone who usually takes the standard deduction, you will be able to get an amount of $1,000 or $2,000 of an additional deduction for your charitable contributions. So if you're someone who already gives to charity, you'll be seeing a lower tax result based on this. And if you don't, this could be a good opportunity to start to look into that. Another new deduction, which you'll be able to take regardless of if you itemize or take the standard deduction, is the qualifying car loan interest. Now, that is on cars purchased from 2025 on. So if you bought a car this year, or if you plan to buy a car in the future, there are some restrictions here also about, I think, final assembly being done in the US. So that's something you want to look into. But if you are purchasing a vehicle and it fits those qualifications and you're paying interest on it, up to $10,000 of that interest can be deducted per year. And once again, that's going to expire after 2028. So what happens after then, we will see. But at the moment, it's set to expire. Now, talking about below the line deduction, so this basically is talking about itemized deductions. So not everybody, this is not going to regard everyone, but if your itemized deductions are more than those standardized deductions amount. And so what are itemized deductions? Usually it's state and local taxes, mortgage interest, medical expenses, charitable contributions, usually those four. So if the total of those four, with some limitations, which we'll talk about later, add up to more than the standard deduction, then you would be considered an itemizer, and it's more beneficial for you to itemize. And so what you need to know is there is a new base floor on charitable contributions. So in most cases, that's going to be 0.5%. So it basically means you don't start taking deductions for your contributions until you get to 0.5% of your income. So it's just there's a similar thing on medical deductions. And also home mortgage interest, there's a deduction there. Was already in place, but that is capped at $750,000 of interest. So you get a deduction for interest up to that amount, but not after that amount. And the final one is the famous SALT tax, state and local tax deduction, which used to be $10,000, has now been raised to $40,000. So if you live in a state where you pay a lot of state taxes, you may find yourself in a situation where you've traditionally been taking the standard deduction. However, it may make sense to look at at itemizing for this year. Again, there is a phase out here at 500,000. So if you're making over that, this amount can phase back down to 10,000, which is what it was previously. Okay, let's talk about credits. So where a deduction is an amount that gets subtracted from your total income, and then that income gets taxed, a credit actually happens after your tax is calculated. So your tax due is calculated, and these amounts are subtracted from your tax owed. So they're not subtracted from your income, but they're subtracted from your tax owed. So we like to see these. These are really great at reducing that tax burden. So what's going on with credits? They are mostly increasing. So the child tax credit, which was previously $2,000, has been raised to $2,200. There are some phase outs here based on income. And the dependent care credit also has been raised to $1,500. So this is if someone takes care of your children or other dependents. That's been raised to $1,500 or $3,000. So if you have kids, probably you'll see a better situation regarding these credits going forward. Energy credits, on the other hand, are going away basically. So the energy efficient home and residential clean energy credit, that is going to terminate as of December 31st of this year. And the EV tax credit for purchasing electric vehicles, that has been discontinued already. So if you were planning on making any of these changes to your home, you definitely want to try to get those done before the end of the year. Okay, let's get into some of the business tax updates. Again, all of these changes are permanent unless otherwise noted. So this is the big one. For all you small business owners, the bonus depreciation is back. Bonus depreciation is back at 100% permanently, and that is effective January 20th, 2025. And so, previously when you were purchasing big items of over $2,500, let's say, you would have to depreciate those. There was some bonus depreciation applied in previous years. It was down to, I believe, 40% this year. And so you weren't able to basically expense those items, right? Take the deduction for those items all in the year you purchased them. That would have had to get spread out over multiple years. Now, when you make those purchases, you are able to take 100% deduction. There are some limitations on what bonus depreciation can be taken on, but pretty much outside of things like real estate or intangibles, things like that, there's a lot of assets that you can get that bonus depreciation on. So again, it's one of those end of the year tax reduction techniques. If you do have some big purchases to make, you can run it by us, but it could make sense to make those purchases before the end of year so you can get that deduction on your 2025 taxes. Okay, this is the other big one. So the qualified business income deduction, which not a lot of people knew, but it was scheduled to go away. It was scheduled to disappear after the 2025 year. And that deduction is a big one. It's a 20% deduction on your business profits for S-Corp owners, for partnership owners. for Schedule C, sole proprietors, all of you have a 20% deduction on your business profits. So that being made permanent is going to not make your taxes go up going forward, and also help with planning, just to know that that's going to be around for a while, at least. Then another one, meal deductions. So this is one that actually did go away. So on-site meal are no longer 100% deductible. There are some exceptions, but 50% meal deductions do remain. So there are the 50% meal category that's still around. So that's when you're having business meals, for example, with clients and things like that. Those can still be deducted at 50%. Okay, research and development. So that deductions for research and development are back. There are a lot of restrictions. So, what constitutes research and development has a very strict rule, which I'll show you on the next slide. But basically, yes, some domestic R&D costs can now be expensed, so you can take deduction for them. There is some retroactive expensing which can happen if you had some expenses for previous years. However, there are some very strict rules, as mentioned, about what exactly is considered research. So there's basically a 4-part test that you have to meet all of these for what you're doing to be considered research. So it has to lead to an improvement of a product. It has to be technological in nature. So we're thinking hard sciences here, like engineering, technology, not something like marketing, for example. That's not gonna qualify. There has to be some sort of uncertainty about the method or the outcome or the approach, and the process had to have been experimental in nature. So this is a really strict test. You have to pass all of these to be able to deduct research and development expenses. And then finally, the pass-through entity taxes. So these were the taxes that were kind of a workaround to some other deduction restrictions, like the SALT cap that we mentioned. Those have remained. They've been confirmed deductible at a federal level. So if you're someone who takes advantage of these taxes, these state taxes mostly, those continue to be a vehicle that you have. Okay, we just wanted to go over a couple other notable updates with this tax law. So there are some 1099 filing rule changes. First one is that, and this is starting next year, the threshold for a 1099 NEC, so this is the 1099 that you would, if you're a business owner, pay to contractors, or if you're a contractor, that you would receive. It used to be $600 minimum. So if you got paid more than $600, you would have to have one of these issued. That minimum has now been raised to $2,000. So a little bit of flexibility now there. And the 1099Ks, so these are the ones that you're going to see from like third-party processors. So maybe if you have Stripe income or other sort of PayPal, other sort of processors that you're getting paid by, the thresholds for reporting here are now $20,000 minimum and 200 transactions. So again, that was a lot lower. So you may see fewer of these going forward. However, all income still needs to be reported, so this doesn't really have a tax implication here. There's a couple new rules for HSAs. You can now pay up to $150 a month or $300 family for direct primary care, and that's without losing HSA eligibility, because these fees are considered qualified expenses for the HSA. And now the high deductible health plans that you would have to have an HSA allow you to provide telehealth coverage. So that's being included now as part of an HSA. There's a new vehicle called the Trump accounts, and these are available for children under 18. They're kind of like an IRA, and there are some contribution limits, but those, like an IRA, are able to grow tax-free. And also, for any children born between 2025 and 2028, parents can opt for a government contribution to get one of these started of $1,000. A couple changes on the 529 plans. There is the distribution limit has been raised to $20,000. And another thing is that you can now use these to pay for not just higher education, but also post-secondary education. So this could be things like professional qualifications. So there's a little bit more flexibility here, a little bit more options if you have a 529, or maybe more reason to look into one if you're thinking about getting one. So that's basically it for this tax law presentation. Thanks a lot for watching. Definitely feel free to reach out to us, info@gradingaccounting.com. We'd be happy to help you out with any questions that you have or any curiosities. And we'll, as mentioned before, we also have a accompanying document PDF that we'll make available to all of you guys. And we'll be in touch going into the end of the year and 2026. So thanks for watching and have a great end of the year.